Look at the headlines on your phone right now. Everyone is shouting that the gold dream is completely dead. They are telling you that the $5,000 gold target is a total illusion because Russia just dumped $4.3 billion worth of gold into the open market. They want you to panic. They want you to sell your hard-earned assets at the absolute bottom. But I need you to forget the media noise and look at the actual numbers. When I was 22 years old, saving my first $10,000 while driving a beaten-up 2006 sedan with a broken bumper, I learned the hard way that the crowd is almost always wrong at major turning points. I remember living in a tiny apartment with no living room sofa for a whole year just to put every single spare dollar into real cash. Flowing assets. And today I am going to give you the raw, unfiltered truth about this gold market distortion. The media says Russia sold 28 tons of gold and that this is the lowest holding since the war started in 2022. But let us do some basic math that your average financial reporter cannot comprehend. Those 28 tons represent exactly 1.2% of Russia's total gold reserves. It is a tiny fraction of their total holdings. It is barely enough to scratch the surface of their balance sheet. So why are they selling? They are selling because they are running out of liquidity. The war in Ukraine has been going on for over 3 years now. European energy sanctions have severely cut their oil and natural gas export revenues, but their military spending is increasing every single day. According to recent financial data, the Russian Ministry of Finance has been quietly liquidating gold and foreign currency from its national wealth fund. They are doing this simply to plug the massive budget holes caused by declining energy revenues. The central bank is not strategically bearish on gold. They are just acting as a cash machine for a cash-strapped government. You need to look at the exact timeline here because dates never lie. The Russian central bank stopped aggressively buying gold in early 2020, but the full-scale war in Ukraine did not start until February 2022. This tells you that they were already accumulating cash and planning for this massive geopolitical conflict years in advance. They bought up almost the entire domestic gold mining output for 2 solid years. And now that the war is burning through billions of dollars, they are forced to sell that gold linearly to stabilize the ruble. It is a desperate fiscal move by a war-torn nation. It is not a strategic trend for the rest of the world, but retail investors see the headline and immediately panic. They think every global central bank is about to dump their gold reserves and run away. Listen to me very carefully, that is completely false. We have seen this exact playbook happen multiple times. In recent history, look at Turkey in 2024. The Turkish central bank dumped over 100 tons of gold in the first half of that year. Why did they do it? Because the Turkish lira was crashing into the ground and their foreign exchange reserves were totally depleted. They had to sell gold to buy US dollars just to keep their banking system on life support. Back then, the internet experts were also screaming that gold was going to zero, but what actually happened, the price of gold ignored the noise and kept making new all-time highs. Because smart money understood that Turkey was a forced seller, not a strategic seller. Look at Poland in late 2024. The National Bank of Poland sold a portion of its gold reserves due to intense fiscal pressure. They needed to expand their military hardware to defend against regional security threats. They did not have enough cash sitting in their treasury, so they tapped their gold savings. And look at China. The media made a massive deal when the People's Bank of China paused its gold buying streak after hitting 2264 tons. The bears started shouting that the Chinese gold rush was officially over, but China did not dump a single ounce. They just strategically paused their purchases because prices hit record highs. A temporary pause at historical highs is a massive sign of strength, not weakness. If you aggregate all these case studies, the pattern becomes blindingly clear. Every single central bank that sold gold did so because of massive internal fiscal stress. They sold because of war expenditures, they sold because of extreme currency devaluation. Not a single central bank sold because they thought gold was a bad asset. They did not panic sell like a retail trader who gets shaken out of his position on a random Tuesday. So let us look at the broader macro picture. Are global central banks net buyers or net sellers of gold right now? The hard data proves they are buying like absolute monsters. According to official reports, central banks purchased a net total of 244 tons of gold in the first quarter of 2025 alone. In 2024, the total central bank gold buying hit 1045 tons. That was the third consecutive year where official sector gold purchases crossed the 1,000-ton mark. This is the second highest annual purchasing volume in human history. So while Russia and Turkey are forced to liquidate their gold to pay for immediate expenses, massive economic powerhouses like India, China, and the Middle Eastern nations are aggressively accumulating. Global central banks remain heavy net buyers of gold. Look at India. The Reserve Bank of India bought over 70 tons of gold recently, maintaining its position as the second largest official buyer in the world. Look at Saudi Arabia, the United Arab Emirates, and Qatar. These oil-producing nations are consistently moving their massive capital reserves out of Western fiat and into physical gold. Their long-term strategy is clear. They want to de-dollarize their economies. They want to protect their national wealth from the weaponization of the US dollar financial system. So on one side of the ledger, you have a few financially broken nations selling gold for survival, and on the other side, you have a massive coalition of wealthy nations hoarding gold for structural protection. The foundational thesis for gold has not changed at all. The only thing that changed is the desperate behavior of a few individual countries. But you have to ask yourself why this news is dropping right now, because across the ocean in Washington, D.C., a massive political drama is unfolding. Donald Trump just hosted the inauguration ceremony for the new Federal Reserve Chairman Kevin Warsh inside the White House. Let me explain to you exactly how insane and unprecedented this move is. Since 2018, the Federal Reserve Chairman has always taken the oath of office inside the Fed headquarters. The President of the United States does not even show up to the event. The last time a Federal Reserve Chairman had their inauguration hosted inside the White House was all the way back in 1987, when Ronald Reagan hosted Alan Greenspan. That was nearly 40 years ago. And before that, George Bush hosted Ben Bernanke in 2006, but even that was not inside the actual White House walls. So why did Trump break a 40-year historical protocol for Kevin Warsh? The answer is simple. He is publicly treating the Federal Reserve Chairman as a member of his political team. He is sending a clear message to the financial markets and to the Fed itself. He wants interest rates lowered immediately because the United States government is sitting on a catastrophic debt bomb. The U.S. national debt has officially cleared the $39 trillion mark. The interest payments alone on this massive mountain of debt now exceed the entire annual U.S. military budget. Think about that for a second. America is spending more money on interest to bondholders than on its Army, Navy, and Air Force combined. Trump wants to implement massive tax cuts and expand domestic manufacturing. But he cannot fund any of these promises if the government has to pay 5% interest on $39 trillion. He desperately needs the Federal Reserve to aggressively cut interest rates to lower the government's borrowing costs. This is a literal battle for fiscal survival. You might think that Kevin Warsh is a known monetary hawk and that he will resist the pressure to cut rates, but history shows us that the relationship between a U.S. president and a Fed chairman is incredibly volatile. It changes based on the severity of the economic crisis. Sometimes the Fed chairman maintains total independence, and sometimes they completely bend to the political will of the executive branch. Let us look at the historical data of the past 8 Federal Reserve chairmen to see how this game is played. First, look at William McChesney Martin. He served for nearly 20 years across 4 different presidents. He famously stated that the Fed's job is to take away the punch bowl just when the party gets going. He completely refused to be a tool for the Treasury Department and established the modern foundation of Fed independence. Second, look at Arthur Burns during the Richard Nixon era. He is the ultimate cautionary tale. He completely surrendered the Fed's independence to Nixon's re-election campaign. Nixon ordered him to keep interest rates artificially low to boost the economy before the election. Burns obeyed the order and it triggered the catastrophic hyperinflation of the 1970s. Third, look at G. William Miller during the Jimmy Carter administration. Carter did not place immense political pressure on him, but Miller was simply incompetent. He completely misjudged the severity of inflation and let the economy spiral out of control. Fourth, look at Paul Volcker. He is the gold standard of financial courage. He ignored the White House entirely and pushed interest rates to an insane 20%. He intentionally triggered a massive economic recession and widespread unemployment just to kill inflation. When Ronald Reagan's team pressured him to cut rates before midterms, Volcker literally walked out of the meeting and ignored them. Fifth, look at Alan Greenspan. He managed to maintain independence while strategically aligning with political goals like tax cuts. He expanded the Fed's influence directly into fiscal policy because of his massive personal reputation. Sixth, look at Ben Bernanke during the 2008 global financial crisis. He worked closely with the Bush and Obama administrations to save the banking system, but he openly defended the Fed's monetary boundary in front of Congress, stating that politics must never dictate interest rate policy. Seventh, look at Janet Yellen. She maintained a highly professional and independent stance, ignoring the early criticisms of Donald Trump during his first term. And eighth, look at Jerome Powell. He faced the most brutal public pressure campaign in modern history. Trump publicly attacked him on social media almost every single week, calling him an enemy of the state. But Powell held the line. He focused entirely on the economic data and defended the institutional independence of the Fed. Even when Trump threatened to fire him or take legal action, Powell did not flinch. So if you look at the historical record, out of the last 8 Fed chairmen, 6 successfully defended their independence, only 2 totally failed. That gives us a historical probability of 75% that the Federal Reserve will maintain its ground. But Kevin Warsh is stepping into an entirely different arena. The Trump of 2026 is far more powerful and aggressive than the Trump of 2017. The U.S. debt situation today is significantly more dangerous than it was a decade ago. Getting pulled into the White House for your inauguration on day one is a massive psychological power play, so the ultimate question for your portfolio is simple. Will Warsh hold the line, or will he break under the pressure of a $39 trillion debt crisis? If he holds the line and keeps interest rates higher for longer, the US dollar will remain strong and gold will face short-term pressure. If he breaks and triggers an aggressive rate-cutting cycle to monetize the national debt, the US dollar will enter a structural decline and gold prices will skyrocket. The ultimate outcome does not depend on economic textbooks. It depends entirely on how long the U.S. Treasury can survive under this massive interest expense. Let us connect all the pieces of this global financial puzzle. The $4.3 billion gold sale by Russia is not the start of a global central bank liquidation trend. Smart investors can see that this is a localized fiscal emergency caused by a prolonged military conflict. But the true macro significance is the timing of this event. It is happening exactly when the political pressure on the Federal Reserve is reaching historical levels. We have a major global gold seller liquidating assets for physical cash, while the leader of the world's largest economy is actively trying to force his central bank to print more money. You have physical gold supply flowing out while the global fiat currency system is preparing for another massive policy U-turn. These two massive opposing forces are colliding directly in the gold market right now, and that is exactly why the price of gold is trapped in a tight consolidation range. If you look closely at the charts, you will see that gold is in a structural downtrend on the daily time frame, but every time it hits the bottom of the range, it completely refuses to drop further. The trading volume is quietly accumulating at the absolute lowest levels of this consolidation pattern. The volume profile shows that smart money is systematically absorbing the shares and the contracts from panicked retail sellers. This is a textbook institutional accumulation pattern. They are using the scary headlines about Russia to scare you out of your hard assets while they quietly build a massive long position behind the scenes. Unless we see an unexpected macro shock or a sudden liquidity crisis, the probability of an upside breakout is significantly higher than a breakdown. But let me give you some real talk from someone who has been in the trenches of the market for years. I am not here to give you empty financial slogans or tell you that everything always goes up. Every single investment carries massive structural risk. If you enter this market based on pure emotion or hype, without a clear risk management plan, you will get absolutely slaughtered. When I started turning my financial life around, I stopped gambling on short-term price predictions. I stopped listening to the mainstream media talking heads who get paid for clicks and views. I structured my net worth around real assets and cash-flowing instruments. I balanced my portfolio with physical protection and high-quality equities like VU and SHAPD, because I know that the financial system is ultimately engineered to protect the elites at the expense of the masses. The committees at the major stock exchanges and the politicians in Washington do not care about your personal retirement account balance. They care about maintaining system liquidity and funding their geopolitical agendas. If they need to rewrite the rules or put immense pressure on institutions to bail out their mistakes, they will do it without hesitation. Just look at how the entire monetary architecture shifted after the 2008 crisis and the 2020 pandemic. Every single time the system faces a massive structural wall, they print more fiat currency and dilute the purchasing power of your hard-earned savings. That is why understanding macro finance is the only real shield you have to protect your family's financial future. Do not buy an asset simply because someone on YouTube tells you it is going to the moon. Look at the balance sheets, look at the macroeconomic data, and analyze the political forces driving the market. In the next video, I am going to share the exact layout of my personal portfolio and show you how I am hedging my capital against this upcoming Federal Reserve policy shift. I am going to break down the specific entry points and stop loss levels I am using to navigate this volatile environment safely. Stop being the ultimate exit liquidity for institutional players who use media narratives to manipulate your behavior. Keep your head cool, protect your capital, and stay disciplined in your execution. See you in the next deep dive.